Thank you, Lizan. Welcome and a very good morning to everybody here in India. We have on board from the PVR management, Mr. Ajay Bijli, the Managing Director, Sanjeev Bijli, Joint Managing Director, Mr. Gautam Datta, the CEO, Mr. Nitin Sood, the Group CFO, and Mr. Rahul Gautam, VP Finance. Without any ado, I'll just hand it over to Nitin to make the opening remarks.
Good morning, everyone. Thanks for taking the time to join PVR's earnings call for Q1 financial year 18-19. I'd like to take you through a snapshot of our performance for the quarter, post which we can have your Q&As. The revenues for the quarter ended 2018 was 700 crores as compared to 653 crores during the corresponding period last year, which is up by 7%. Revenue for exhibition business were up by 11%. And PVR sold its stake in the subsidiary Blue, our bowling business, in the last financial year. Hence, the consolidated revenue numbers are not comparable. EBITDA for the quarter was 141 crores as against 131 crores in the same period last year, which is up by 8%. And EBITDA margin for the quarter was robust at 20.2%. PAT for the quarter was 52 crores as compared to 44 crores during the corresponding period of last year, which is a growth of 17%. And the quarter witnessed a very strong operating performance led by 12% growth in box office revenues and admissions growth of 8%. This is despite a very strong base of Bahubali last quarter. F&B revenues were up by 23% from 165 crores to 203 crores. Advertising revenues grew by 6% to 72 crores from 67 crores last year. And the company has added 9 new screens in the current financial year and has a pipeline of over 100 screens currently under fit-out. We expect to open around 90 screens in the current financial year. It's looking like a great box office year with several big films lined up for release during the balance 9 months, and we're expecting a strong year ahead of us. Thanks very much.
Abhishek, we can now open it up for Q&A, please.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, my first question is on the ATP hike being only 2%. This is lower than the data which we normally see, in spite of Hollywood being 34% versus 22% in the base. So obviously, Hollywood is consumed more by the premium audience. The base obviously has Bahubali, I understand that. But in spite of that, why we are not able to charge higher premium for the Hollywood, if you could take us through that?
Yeah, so I think it's a conscious decision on managing ATPs. We took a big ATP growth last year. And also on a quarter-on-quarter basis, if you look at it, we had Bahubali, which is a very big film in Q1 of last year, which ran for almost 5 weeks. So normally ticket prices are up with big films. And because we had a very big film last year in Q1, you had high ATPs consecutively for 5 weeks. As compared to that, I think in this year, you only had Avengers, which was positioned as a big film. All the other films did good box office, but they were not positioned as big films.
They didn't open as a blockbuster. So if you look at Razi, 102 Not Out, a lot of others, Veeredi Wedding, they were all not slated to be the blockbuster film.
So, because last year you took a lot of hike, does it mean for the full year 5 to 6% hike looks difficult because one quarter is already gone?
Yeah, I think our conscious decision this year is to take a lower ticket price growth, but have a higher footfall growth, same-store growth in admissions. That's going to be the focus area.
My second question is on your cost items. So if you see rent is up only 3% escalation, which is good, and CAM charges are down 4%. So rent last year was a big issue because of the competitive intensity. So now is that behind? And similarly, if you could tell why CAM is down 4%?
No, so one, these numbers may strictly not be comparable to Q1 because we are comparing numbers in a pre-GST regime to post-GST regime. In real sense, there is a growth of about 5 to 6% in rental cost, and similarly in some of the other costs as well. But we are comparing pre-GST to post-GST numbers, so some of the growth is not reflecting effectively due to the tax credits, etc., which are factored in on the cost side, as well as some of that which is coming on the revenue side. So I think you will see rental cost is growing, but our average growth rate is about 5 to 6% on an annual basis.
My next question is on expansion strategy. If you see the ad growth of yours versus the number 2 player, the gap last 4 quarters has been there. So what are you doing from a conscious strategy? What are you doing to address that gap? Because if I see the pipeline of properties for the balance part of the year, out of the 13 properties, I think 10 are in non-metro cities. The number of screens might be higher because in Chennai you are opening a lot of screens. So a lot of non-metro screens may not add to the advertising yield. So that's the question. And second, expansion into MENA. When India has opportunities, MENA obviously has very high risk from a geopolitical. So could you take us through your thoughts behind that?
I think the advertising part, Gautam, if you can.
Okay. So basically there has been a conscious strategy this time to be able to again work around what the consumer wants. So we have actually seen if we could sort of limit the volume growth on while there is enough and more that we could do around that. But we've consciously wanted to take a value growth on advertising, and a bulk of our growth that has actually come from that. So we've managed to get a certain amount of prestige and reputation back into this category and this advertising bit, which we believe is a need of the hour. And as leaders, we needed to take that call. We did not want to sort of add on the volume in terms of number of minutes of advertising. So that's really what we've been trying to do. Your second question was that whether it's metro or a non-metro, our advertising propensity within our screens is fairly, similar in terms of consumption of time, and we manage that through our systems that there is no differentiation. There is enough and more demand even in the tier 2 and 3 cinemas. The players may vary. There will maybe more retail and other telecom clients which kind of get to the tier 2 and 3 cinemas. But in terms of consumption story, that doesn't change at all.
I like to stop here. See, it does matter because if you see the number 2 player has been able to grow much faster because they are adding a lot of premium properties in the metro cities. So
no, it's largely on account of the volume growth. It's not so much on account of the premium sites that they have. It's largely on account of the number of minutes of advertising that they have managed.
And Avnish, just to add to what Gautam is saying, there is no change in our annual outlook of advertising revenue growth. Our advertising revenue growth for the full year is projected at 18 to 20%, and we stick by that guidance. I think it will vary quarter on quarter. Q3 is going to be the biggest quarter of this year with 4 big films. And as we've historically said, advertising revenue is actually dependent on blockbuster films rather than box office performance. So our annual guidance of 18 to 20% growth in advertising revenue stays.
And a lot of properties next year are getting added in Delhi, Mumbai, Bangalore. So it's just that this particular year, Delhi only has 16 screens, but these are also prime properties. Chennai are prime properties. Hyderabad is a prime property. So this keeps happening when, every year you have a different portfolio of properties. So advertising definitely will will be pretty much in line with how we've been growing. And they're coming from a very low base, and which is the reason why the percentage increase seems higher.
I had also asked on the MENA.
Yeah, so MENA, basically, if you look at the way we're doing it, is first of all, there's a JV with Al Futtaim Group. So straight away, it's not a very capital-intensive model. Also, we scouted the entire market and we realized that the premium director's cut and high-end offering that PVR has got in India, that is something which is missing, and there's a huge gap in all these places where still the consumer is more sensitive to a great experience than price. So I think we have a product that we have made in India, which perhaps will have a better reception in these places where people are really looking at a very, very high-end differential experience. So from that point of view, we felt there was a gap in the market. And the model is the JV model for the MENA region, and further for Saudi there'll be another JV. So I think the capital intensity and the requirement of PVR will not be that high. What we're looking at is basically getting partners on board and bringing our expertise and management, whatever experience that we've got over the years, for the last 28 years, into these joint ventures and into this region, which currently the current partners, neither these new virgin territories have. So we do believe that we have a good opportunity here to make a good return.
Okay, sir, that's all from my side. Thank you.
And just to add one thing, that also the Indian film industry, the diaspora and the local consumer is also, very much fond of Indian films. So we were looking at places which are one flight away, and also where our own content is as popular as it is in India.
Thank you. The next question is from the line of Swati M. from East Capital. Please go ahead.
Hi, thank you for taking my question. I think the first question I want to ask is regarding the government's response to the court's order that they'll have to respond to the public interest litigation pending in the court. Do you have any update? It was supposed the deadline was yesterday, I think.
Well, actually, we can only answer the question if you have a tiffin in your hand. Not just joking. Anyway, so I think on a serious note, Nitin, our CFO, will tell you where the legal matter stands.
See, our understanding is the Government Council has sought 2 more weeks' time to file a reply with the court, and that's what happened in the proceedings yesterday.
Okay, I understand. And then I saw in your presentation you mentioned in the notes that the GST exemption, you are now recognizing it in other income for the state of Rajasthan, but only 50% of it. Is that what the state has officially declared?
Yes, so the erstwhile policy in Rajasthan was that there was a 50% exemption under their erstwhile policy, which they've continued by coming out with a new policy whereby they're saying 50% of whatever is the SGST portion, we will continue to refund to cinemas. So they are the first state who's come out actually with a refund mechanism and a policy, and we've recognized it in accordance with the policy.
Okay, so the refund amount is the same in the previous scheme and also this scheme, right?
Refund, so the previous...
Not amount, but maybe the percentage or the norms is the same.
Yes, the policy is consistent with that. That's right.
Okay, sure. And then you already mentioned about ATP growth, that you're consciously trying to control it. But is football actually a function of ATP for you guys, given the premium brand? I thought it was mainly a function of content.
No, while of course we operate in a very premium circuit, the reality is that we cater to all sorts of audiences. Even a premium site will have different profiles of customer coming in. So ATP does play a very pivotal role in being able to garner more footfall, and if we can sort of keep the ATP under control, you can actually get more footfalls and get people to come and watch the smaller films as well. So ATP does play a very important role.
And also, I'd like to just add, if you look at the overall revenue, that is ATP multiplied by the number of people who come. So we've achieved about 36% occupancy and a revenue growth on film income. I think film income should also be looked in totality, has grown by 12%, so which is quite a healthy growth. So as Gautam rightly put, you can't look at one thing in isolation. You look at the overall impact of what is the net film income. And more people come in, and therefore more gets spent on F&B, and more advertisers also feel happier if your cinemas are running at a high occupancy.
And see, you have to look at also in context of the fact that we are looking all these numbers in context of the Q1 of last year, which was a very, very strong, which was the best quarter of the year last year. And we've got a 5% same-store growth overall, box, F&B and advertising put together on those numbers. So this is clearly looking like a very good year ahead. This is a very strong performance. To achieve a same-store footfall growth on top of such a strong quarter and go back to peak occupancy levels is a big change or growth in the business.
Okay, great. Can I just understand on the ATP growth, how does the mix change with premium formats versus non-metro? What are your expectations? Because as premium formats screens increase, ATP growth should come in, but non-metro maybe the ticket prices are lower. But what should we expect in the medium term? And also, does the ticket price caps which state governments have, are they applicable in any form on this premium format?
Yeah, so ticket pricing across most parts of the country is deregulated, except for few South Indian states, and they have their own pricing regulations which come in play. And in case of some of these premium formats, you need a specific approval. Some states give a specific approval, some states don't. In states which don't, they don't have these premium formats. So that's a simple answer to your question. And yes, our pricing is very, very varied across Tier 1, Tier 2, Tier 3, Tier 4, all the cities as well as across formats. So they will continue to remain varied because we build according to the customer profile in the catchment. But on an overall level, ticket pricing, I think our short to long-term guidances will continue to grow with inflation. And that's what we anticipate. We are still adding almost 50 to 60% of the portfolio in big cities. So our overall ticket pricing will remain at existing levels, and there is no reason why our ticket pricing will go down from where we are right now.
Okay. Lastly, maybe on the F&B part. So right now it's business as usual, right? You're selling at... sorry?
Yeah, yes, you're absolutely right.
Okay. But is there any strategy to deal with this entire thing in the sense of combo packs or maybe products across different price points? I mean, what are your thoughts and what are your expectations from this PIL?
No, we already have a variety of food that we offer at various price points. So I think we're going to continue to give people quality because ultimately people want to come to experience an overall wholesome quality experience. So we don't want to compromise on the ingredients of what the F&B ultimate offering is given to the consumers. So we already have a lot of variety at different price points. Unfortunately, some perceptions have got created by one or two items here and there. So which is the reason why all this has happened. But we don't want to comment on this case which is going on because it is sub judice. And so we'll see the outcome of that whenever it comes to hearing. So currently it's not correct for us to comment on a matter which is sub judice.
Sure. Thanks. And just on the personal expenses, the bonuses and the salary hikes are included in this number which we have in the quarter, right?
That's right.
Okay. Thank you so much.
Thank you. The next question is from the line of Urmil Shah from IDBI Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is, are we still maintaining the outlook as regards the screen addition for rest of the year, which, means, a good ask rate for the subsequent quarters. So given, where we stand right now, which is the quarter you think will have to do the heavy lifting?
Quarter three. Quarter three is going to be the biggest quarter of the year. There are about 3 to 4 big blockbuster films which are kind of slated, and it's also Diwali time.
So my question was on the screen addition, sir.
Screen addition, basically 14 in our presentation we've already written. I think that 14 of our screens are ready. Yeah. One multiplex opened yesterday in Mysore, and 2 in Chennai, and 1 more in Mysore, and 1 in Karnal are awaiting licenses. So it'll all get bunched up. We've given a guidance of 90, but it's not necessary that it gets spread, divided by 4 in every quarter. All of a sudden, we may have a quarter with 30, 40 screens open. But there's a good chance that at least this quarter, over 25 odd screens should open. And then again, you'll have another 20 odd, 25 to 30 in the next quarter, and then some big ones in the last quarter. So all these are under fit out. Under various stages of finishing. Some are finished.
And we have 3 large properties opening this year, 2 10-screen properties opening in Chennai, and 1 12-screen property opening in Delhi. So when you look at the number, I think out of this 90, about 32 screens are from 3 locations alone.
Sure. And as regards follow-up on the ad revenue growth, in the past we have been able to, blockbuster rates which have been substantially higher. So, given that there were a couple of big movies in Q1 as well, so have the premium rates been in line with in the past, or they were slightly higher, given that we said that most of the growth was driven by higher realization?
Actually, if you see, there weren't many blockbuster films. Sanju just had a couple of days of impact in the quarter. But other than that, except for Avengers, there wasn't a film that got classified as the blockbuster film. And as I said, we wanted to consciously sort of work towards getting better yield per second from our advertising. So, and that's the game we've played this quarter. We continue to want to consolidate on that level of limiting our advertising time and giving better experience to consumers. And we will play the value game more stringently even in the coming quarters. But as Nitin said, we keep up to our guidance, and we will keep up to that growth rate that we had initially given.
Sure. So my last question, as regards the decline in the repairs and maintenance cost, does that include a bit of spillover that might happen in the subsequent quarters?
Yeah, it's possible because, see, it's also a function of how the box office is running and what time and opportunity that we get to close down and repair and do some bit of renovation work. So that's possible.
So what is the kind of, broad run rate we should look at?
It's very, very, very difficult to comment on that.
All right. Thanks and all the best.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi, good afternoon, gentlemen, and congrats for, a healthy footfall growth in this quarter, given our cautious ATP strategy.
Thank you.
Just one clarification on this. Now, Nitin did mention, continuing of this cautious ATP strategy, but we are still retaining our 3 to 5% sort of growth in ATP. Is this largely driven by the premiumization and the new screen additions that we will be coming up with, or it's a more a movie-based content-based, rejig and pricing which will drive this growth?
Actually, bit of both. We are adding some premium formats. Recliners are getting added. Again, this is a need of the consumer. So that may sort of propel the ATP growth. And plus, as I said, in quarter 2 and 3, more in quarter 3, there are some big blockbuster films which are slated to come, which automatically takes the ATP higher. So we would be in line with the percentage that we have spoken about.
Okay, that's helpful. Now, secondly, on the advertisement revenue, while we are still maintaining 18-20% growth for the full year, at the same time, we are being cautious in terms of increasing the ad volumes beyond a point. So this will be largely driven by only ad yields, or there are other avenues within the screen which we are also capitalizing on?
There is a whole lot of strategy. So there is, of course, on-screen and there is a very conscious effort to drive off-screen revenues as well. So you're absolutely right. From off-screen to sponsorship, both are being looked at. But we are very conscious that at no point in time we should tip over on the consumer experience. And that's the game that we would want to play this year.
Sure. Another clarification on, other operating revenues which have dipped pretty significantly in this quarter. Is this largely because of Blu-ray being there in the base quarter, or there is something more to it?
Yeah. So when you look at our other operating revenues, till last year Q1, we were accounting for entertainment tax exemption holidays that we were getting under the erstwhile regime in that number. So if you look at, there's almost 13 crores of income on account of tax subsidies that we got in Q1 of last year, which no longer exists in Q1 of this year. So the big drop in other operating revenue is essentially on account of that.
No, but, Nitin, even if I exclude that 13-14 crores of, one time in a way, there is still a decent drop there. And this is across the convenience fee, other operating income across. So
when you look at the breakup of revenue analysis on slide 10 of our investor presentation, it gives a full breakup, which is on other operating income, which is down from 22 crores last year to 11 crores this year. It is down by 11 crores, out of which 13.5 crore drop is largely on account of these entertainment tax holidays no longer being accounted under the new regime. And when you look at our convenience fee income, which is down from 16 crores to 11.5 crores, that's largely on account of the fact that our deals with two partners, Just Dial and Ticket New, are over. They are no longer part of our online aggregator strategy. But we are also in the process of our contracts with existing aggregators are up for renewal later this month. So some of it will come back as we kind of renegotiate those contracts.
Sure. So the Book My Show contract and other these contracts are yet to be renewed. They're not yet done.
Yes. We have a certain pipeline in terms of when these contracts are coming up for renewal this year, and based on the renegotiation, this underlying income will also undergo a change.
Fair enough. Last question, just a clarification on MENA. While you did mention about the opportunities and the premium screen focused, over there, any, volume or any guidance you can share in terms of the number of screens we are looking over there from a 1 or 3 year perspective and the capex involved there?
I think it's slightly early. I think we're in the process of negotiating the whole JV and figuring out the entire business plan for that region with our partners. So we'll be in a better position to comment on the same in the next 60 days. So I think we'll hold on to making a comment on that for at least next 60 days.
Okay. So, Nitin, just one clarification. In our earlier remarks, we did mention, the demographics similar to India and probably, the fascination for Indian content over there. Are we looking at other such geographies as well, or it is a one-off case and, MENA is only one of such territories wherein we are looking to expand?
No, MENA is a very large territory with Saudi opening up, and as I said, wherever there is there's a gap in the market for a quality exhibition experience which PVR can provide, and secondly, where there is a robust content pipeline and Indian and Hollywood, which can make sure the cinemas sustain themselves. Competitive environment is not so fierce, and of course the regulatory environment is good, and the shopping center mall development is happening. So all the boxes have to get ticked But currently, that's it. We've got a cinema which is going to get, I think, under fit out in Colombo very shortly, which is Sri Lanka. And other than that, it's really the MENA region.
Okay. Great, sir. Thanks a lot for the answers and all the best.
Thank you.
Thank you. The next question is from the line of Jay Doshi from Kotak Securities. Please go ahead.
Hi, thank you for the opportunity. My question is, let's assume that, if you were to get a favorable verdict from the court on this entire F&B issue, in that case, would you continue to sort of price your F&B offerings the way it is right now, or are you proactively planning to revisit and improve the price-value equation in favor of consumers, especially for the one or two items where generally concerns have been raised on social media? And how should we think about your, F&B gross margin and F&B spends per head growth going forward? And this is assuming, you have no sort of adverse verdict or ruling in this matter.
So, to your point, this case has kind of opened up a lot of communication and debate, and hence we've heard the consumer, and we will want to sort of see what best can be done from. There were already, as Mr. Bijli said, there were products and offers which were there. We would want to sort of market those more aggressively so that everyone is aware what are the offers available around the F&B. And we believe that the SPH growth is going to be the way it is. Even if we were to sort of correct the prices of a few items, we should be able to gain more in terms of the strike rate and the volume. So technically, I think we should be in line with our SPH growth one way or the other.
And just to add to that, for us, the number one person is the consumer. So I think we are a consumer-focused company, and of course, all this is happening, but we are just increasing the decibel of our offerings as well, which are there, which I think people will appreciate that there is quality behind it. And if there is any, course correction that needs to be done in terms of our menu, our offering, we are happy to do that. Because ultimately, we really want the consumer to feel happy, and we want him to get his money's worth when he comes over there.
Just to follow up here, when this question was raised in past, I think one of the challenges that we were told that this business faces is that in that 10-minute interval, you can only cater to a small section of the entire audience. And so the objective was always to sort of try and maximize the better monetize in terms of, the offerings that you have, and catering to the entire 80-90% of audiences was practically sort of very difficult. Do you think that there is room to sort of have a model where, right now maybe about 50% of your audience is consuming F&B, you sort of revisit the entire strategy such that you are able to cater to a higher number, perhaps at a much more affordable price point? Is that possible, or it still remains a big issue or constraint or bottleneck?
See, what you're saying is a very general objective. Our business is broken down into various parts of the day and various time slots. So the simple answer is yes, it is possible to attract and serve more customers. There are pockets or time frames where it is not possible because we are already at our peak. So the answer is both yes and no, because we all discuss averages here. Our business is not, average is a function of how we utilize each time slot and what we do with each time slot. So what has happened, I think, over a period of time and which we are actively working on from a correction perspective, our ticket price has become very dynamic. If you look at over the period of time, from time of the day to morning, evening, weekday, weekends. And we have done some interesting experiments in a lot of markets which are showing very good results. Unfortunately, I think food and beverage pricing hasn't become so dynamic as our ticket pricing has become dynamic. So we are doing a lot of work now actively to make the whole S&P pricing more dynamic and make the whole price value equation sustainable for a certain segment of customer who's coming on a weekday versus who's coming on a weekend. And we are already running some experiments where we are seeing healthy growth with price value equation being corrected to some level. But I think we will do everything to make the whole value proposition more attractive for a customer and make the whole offering more affordable and more value cautious for a customer. So I think a lot of stuff that we are doing on the background, irrespective of what's happening on the court, to make the whole movie-going experience much better for the consumer. And we think this will pay dividend during the course of the year.
Understood. And I have one more question, if I may, answer. Sure. Could you quantify, the size of opportunity you're seeing in MENA markets? How big is the market there in terms of population or potential for new screens, and who are the players right now? I think Saudi Arabia has perhaps opened up, but the other regions that you may be looking at would already have some screens or exhibitors at present, right?
Yeah, I think so. We are still, as I mentioned, we are still doing a business plan for that market, and we are working with a local partner there who's who's one of the largest private companies in the entire Middle East region. So slightly premature for us to comment, but I think Saudi will lead the pack in terms of what we intend to do, because the market is just opening up there. Apart from that, I think in some markets like Dubai, UAE, etc., we think there are opportunities to do 3 to 5 flagship projects over the period of next few years. Some of the other markets we are still in the early stage of evaluation, but we think it's a decent size opportunity. But we'll be in a better position to comment only, I think, in next 60 to 90 days as we firm up the business plan for the geography.
Right. And just a small one on that. So Saudi, I understand, is opening up, but other markets may already have screens. So are those markets that you're looking at, let's say Dubai, underpenetrated in terms of screens, and which sort of makes that opportunity attractive for you and your local partner? Or do you think the quality of experience is not as that great, offered by the existing operators, which perhaps gives you an opportunity to gain market share? So is it a market share or under-penetration which drives you to, or attracts you to those markets?
I think, yeah. So in a lot of these markets, it is about the quality of experience which is available in these markets. And these markets are seeing new modern developments which are much better than what was built there 5 years or 10 years ago. So there is an opportunity to improve the quality of experience in some of these markets. The pricing power in some of these markets is extremely high. For example, in markets like Dubai, the average ticket prices for a normal seat is about 40 to 45 dirham. The premium seats is as high as 200 dirham. Saudi, I'm told, is also significantly higher. So I think it's different for each market, each country, and each pocket. There is no one answer for every single country.
That is very helpful. Thank you so much, and good luck.
Thank you. The next question is on the line of Rohit Dokania from IDFC Securities. Please go ahead.
Yeah, hi, good afternoon. Thank you for the opportunity. Just one question from my side. Obviously, we understand that the matter is sub judice as far as Maharashtra is concerned, and you cannot talk about it. But if I'm not wrong, the High Court of Jammu and Kashmir has probably allowed outside food inside the theatres. Now, I understand you don't have any screens out there, but probably by the end of this year you might. So just want to understand, how you would be approaching that market once you launch, under the new sort of regulation or the directive that's come from the High Court.
Sure. So my understanding is, yes, you are correct. There is some order which has been passed. Unfortunately, I think there are only 1 or 2 cinemas which exist in that market, and there was no representation or no contest, and High Court just passed an order based on the petitioner's appeal. Also, if you look at that order and if you read that order, it also has conditions like people below the age of 18 years can't go to a cinema till 3 o'clock, and so on. The Jammu and Kashmir Act of cinema regulations was written in 1975 has not seen a single change. Simply because no cinemas have lobbied with the government for any change at all in the last 50 to 60 years, because no cinemas have really opened. So in some sense, while this order is relevant, but I don't think it has too much of a consequence because there's nobody which gets impacted there. On a similar matter, there has been order by the Madhya Pradesh High Court where a similar PIL was filed around trying to control prices and also allowing outside food in cinemas, which was dismissed by the Jabalpur High Court, which they have clearly said, if you read the judgment, it is a private contract between the enterprise and a consumer, and court has no reason to interfere between that. So there have been, I think, two matters which have been treated differently by two different high courts. I won't read too much into it for the moment, but I understand that I think one of the cinemas which exists there is also part of MAI, and we are discussing with them. I think most likely that order will get challenged in the Supreme Court.
Sure, this is helpful. Thanks a lot and wish you all the best.
Thank you. The next question is from the line of Amit Kumar from Investec Capital. Please go ahead.
Yeah, thank you so much for the opportunity, sir. Just a couple of questions from my end. So this other operating, revenue, is there any reason? I mean, Just Dial is a fairly, credible player, out there in the market, and we understand Ticket New has also been acquired by Paytm. Any reason why the existing contracts were not, renewed? I mean, any sort of, issues, in terms of receivables or anything of that sort?
With the existing guys?
Yes.
With
these two guys.
Yeah, we have not renewed them because those operators are insignificant and not contributing anything to the ticketing inventory. And there is no point on renewing contracts with operators who are insignificant to our overall sales mix.
But the impact on the overall convenience fee seems to be, pretty, significant. So is there a case that they were, making some sort of fixed fee payments to you, minimum guarantee plus revenue share kind of payments?
They had made some fixed fee payment to us in lieu of rights to sell PVR inventory, and I think unfortunately their business models didn't take off, as a result of which they are out of the picture.
All right, understood that. So the second one is, when we look at your top line has, delivered quite well, in fact, even slightly ahead of our expectations. But when you look at margins have been sort of slightly, on the weaker side. And in fact, even when I go back and compare it to 1Q, FY17, it's a 12%, CAGR in, revenue terms. But, margins, despite GST and, input tax rates, etc., have gone up by cumulatively only 70 bips, over a 2-year period. And, 2 points which I want to sort of discuss in that respect. One is, employee cost, which on a high base has sort of again, gone up by almost 10%, YOY. And the other one is rentals, which is despite the fact that, again, you have sort of, GST, input tax credits. It has gone up by about 7%. So, if I sort of exclude the, impact of, service tax, that's a pretty, high jump. We are looking at almost a 20%, kind of jump in, rentals, on a like-to-like, basis. So, if you could just sort of comment on, these two, please.
Yeah. So, two parts. One, the fact is, from a GST gain perspective, any benefits that we've got, we've completely passed it on to the consumers. So, net, there is no gain reflected in any of these numbers. Any benefit on account of input tax credits that we've got versus whatever the existing tax rates have been passed on in the pricing back to the customers. We've not increased pricing across products to take care of that situation. That's number one. Number two, your second question was around people cost, etc. And we've never given a guidance that some base is high or some base is low. People cost will continue to grow at between 8 to 10% on same stores. We believe that wage inflation in India will continue to remain high, given the growth that is happening. Some quarters may be slightly lower, some quarters may be higher. So we don't think there is any change really therein. And as I commented earlier, you're right. In the current quarter, some of the growth around rental costs, etc., is appearing lower simply because the costs reflect the input tax credit. Yes, the overall cost numbers across some costs are higher, but they are offset by some of the lower cost growth in some other heads. Rental continues to grow at 6 to 7% on an annual basis. So yes, that inflation is there right now.
So just one sort of small, follow-up. I understood on the employee cost bit, but, rentals. So we've seen your screen sort of, grow by around 8%. Rental up 7%, but we adjust for service tax. It's actually not a 6-7%. It's almost like a double-digit, kind of increase in, rental, which is why, just wanted some sort of clarity. And are you seeing, a bit of pressure on the, rental side? I thought it was there sort of last year, but we thought that, those renewals would have been, pretty much done and dusted with, now.
Not really. So I think rental costs, as we've given the guidance, and rental costs continue to remain under pressure, not from the existing sites, but in terms of any new sites that will open, and also with respect to if any new screens end up coming for renegotiation, which is less than 5% of the total screens in a year. But yes, rental intensity in the market continues to remain high. So yes, there will be pressure on rental costs. But we believe that will get offset by the increase in revenues that we are kind of working on.
All right. Just a bookkeeping question. You've given the, share of English, films in 1Q, this year, last year. What will be that for Hindi and, regional, if you can please help me with that?
So if you look at slide 11 of our presentation, our Hindi box office in Q1 last year was 58%, which is now 48% this quarter because Avengers was the biggest film. And our regional film contribution, which was 20% last year, is 18% in this specific quarter.
Got it, sir. Thank you. That's it from my end.
Thank you. The next question is from the line of Vikram Ramalingam from Maybank. Please go ahead.
Yeah, so my first question is regarding F&B. You and your competitor both have been able to increase spend per head on F&B. And what is the specific reason? Is it because of the film slate for this quarter or higher conversion, premium products?
Yeah, so bulk of the growth is coming from higher conversion. There is about a very small pricing growth in there. Our focus is really to drive more consumption and items per head. And as I mentioned to somebody else earlier during the call, we are doing a lot of stuff around solving for the price-value equation on various time slots to solve for the whole F&B and drive consumption up.
Usually a film slate in a particular quarter does have some impact as well, right?
Yes. See, big films and family films clearly have a higher propensity to spend. Larger groups also means higher propensity to spend on F&B. So clearly, yes, that does have an impact.
Okay. My second question is regarding the ad revenue. Now, considering your strategy is going to be to increase ad revenue via value, my question is there any specific metrics that you all provide in which you think you'll be able to achieve this? Like generally, what are the metrics that you all provide to your advertisers, and how are you going to pitch that you need to pay more for a particular to a particular client? I mean, if you can discuss.
Yeah, I think our metrics is the quality of audience that we get, and there is, I'm sure there are different metrics that which different clients look for, because cinema advertising is not based on footfalls alone. Cinema advertising is really based on the quality of audience that we attract, and that's the reason the advertising revenues that we generate are significantly higher than most of the others. But there is no one metric that we share with advertisers.
All right. That's it from my side. Thank you.
Thank you. The next question is on the line of Naval Seth from MK Global. Please go ahead.
Yes, thanks a lot for the opportunity, sir. I have two questions. First is on ad. As you stated that you are trying to restrict volumes to improve the consumer experience. So any number you want to state that on YOY basis, or say if you were on say 15 minutes hypothetically or 20 minutes, so you want to cut down by say what percentage point if you cannot give the absolute number of minutes?
No, so that number really varies cinema by cinema, consumption varies cinema by cinema. I don't have a number with me.
No, I don't want number. I just want the percentage term, the volume, cut or restriction you are trying to put and taking the yield improvement.
So as I said, we do not try to exceed 20 to 22 minutes of overall advertising minutes, split between beginning of the film and during intermission. And that's the broad number that we try to stick to.
And you don't want this to reduce also, say, to 20 or 18?
No.
Okay. And second, on the F&B, as you stated that you are trying to experiment on dynamic pricing the way it is on ATP. So can that also have some legal implication to, sell the same food at the different pricing at the different point of time, or that's allowed again because of so many things happening around the F&B?
It's like we operate under almost the same license as restaurants. So there is no legal implication of that.
Okay. Yeah. Thanks a lot and all the best.
Thank you. The next question is from the line of Mansi Shah from Tabro Capital. Please go ahead.
Good afternoon, sir. Thank you for taking my question. So can you throw some light on what is the percentage of customers using the premium screens in India overall?
Sorry, can you repeat your question, please?
Yeah, so my question was, sir, what are the percentage of customers using the premium screens?
Percentage of customers using the premium screen. I don't have that number readily with me, but our average occupancy across premium screen formats is marginally higher than our regular screen formats, and our ticket pricing premium is also significantly higher for our premium format screens. I don't have exactly the number for these. I can give it to you offline.
Yeah, that's okay. That's completely fine. So one more question was, what are the capex incurred in the opening of screens in non-metro versus metro cities?
There is no specific number. Again, it is driven by location and pricing power. Our average capex per screen is approximately 3 crores a screen is what we are spending. But it really varies between as low as 2 crores a screen to 4 crores a screen, depending upon which part of the market that we are building the cinema for.
Okay. And so you mentioned earlier that the occupancy rate is around 35%. So do you see any sustainable growth in the occupancy rate?
Sorry, occupancy ratios. See, you look at the box office here, and I think the general guidance that we are giving this year is and we've always said that our business is slightly cyclical, dependent on content. And if you look at a 5-year period, there are years with higher occupancies and there are years with slightly lower occupancies. This is currently based on how the Q1 has panned out and what the content outlook for the rest of the year is looking like. Is looking like one of the good years with higher occupancies on the threshold. So clearly, I think our outlook for this year is on a positive side. And hopefully in that seasonality of the business, this is looking like a much bigger and high year.
Okay, sir. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Abhishek Ranganathan from Ambit Capital. Please go ahead.
Yeah. I have a question on the F&B. How divergent is the consumption pattern of F&B for weekdays? I mean, you mentioned about dynamic pricing in ATP and how possibly it has helped you in the food in conversion. I want to understand his current spending patterns on F&B. How divergent are they on weekdays, non-weekdays, or the peak? How would you measure it?
So we measure it because we have all the data based on the timeline of consumption and who's consuming what. And the consumption patterns are very divergent. And we know exactly what is the strike rate in different pockets and different catchments. We also measure it in relation to ticket pricing. We also measure it in relation to the kind of customers that we are attracting. So we are doing a lot of work driven by data to see how do we address some of these issues and how do we ensure that in pockets where the consumption is low and the price-value equation is not consistent, how do we solve for that to drive consumption up? And in pockets where we have the price-value equation right or the spending is there, how do we ensure that we reach out to more people and are able to sell more? How do we solve through technology? Pre-ordering, delivery on seats, on pickup at the counter. So how do we increase delivery time frames during stress time and how do we solve for price value equation for times where consumption is low.
So just strike rate, if I just use one metric to measure, let's say strike rate, how divergent would it be? I mean, you could give me a quantitative, whatever answer.
So if assuming our average strike rate is 30%, it would vary to as low as 20% to 35%. It would be that variation, depending upon which part of the day we are looking at.
So I didn't get it. Is it 30? If it is 30%, it can go down to 20 in a location where the price value proposition or the spending.
Yeah, it is also based on time of the day, more than just the location. And we have cinemas which do much higher strike rates, and there are cinemas which do much lower strike rates. I'm just giving an example, but yeah, there is quite a bit of variation because the profile of customer in each segment is very different. And we have to solve for pockets where there is a price-sensitive customer but not consuming enough. Hello?
So the line for Abhishek Ranganathan has got disconnected.
Sure. Any further questions or we can wrap up?
So we have the line for Abhishek Ranganathan reconnected. Sir, your line is reconnected.
Sure.
Sorry. Yeah. So you said about peak and non-peak in the time of the day. So it's...
Yeah, it's quite varied depending upon which part of the day. So I think the way we look at our business is we have to solve the problem depending upon what kind of customer we are reaching out to. And the businesses, while we look at averages, ultimately we have to solve for every single customer. How do I ensure a morning weekday customer is also consuming versus how do I ensure that a weekend customer is also consuming. So we are doing a lot of stuff to solve for that, for each segment of customer, to make the whole price value equation more attractive for a different segment of customers.
Sure, understood. Sure. Thanks.
Thank you. Ladies and gentlemen, that's the last question. I now hand the conference over to the management for their closing comments.
Yeah, I just want to thank everyone for taking out time for this call. And if you have any follow-up questions, you can reach out to me directly or my colleague Rahul Gautam. And we are happy to answer your questions. Thank you very much.